Welcome back to a new series on ChartWatch, and I think the most appropriate series to go after futures is now to talk about options because those two get mixed up a lot. And so this lesson is going to be very quick. This is just going to be a quick lesson on what are options. This is going to be a series with I think around 7, maybe another couple bonus lessons. We'll see. But yeah, so in this lesson, we're going to talk about what are options, and the goal of this lesson is to introduce options as a financial contract and explain what makes them different from buying a stock or futures, and kind of just go over a few simple terms in this lesson. So let's start with the core definition. An option is a type of financial contract that gives the buyer the right, but not the obligation, to buy or sell an asset at a specific price before a certain date. That might sound like a little technical at first, but let's break it down piece by piece. So when we say an asset, we're talking about something that trades on the market. This is typically a stock, an ETF, or even an index. This is called an underlying asset because the option is built on top of it. Now, there are other types of underlying assets like bonds, commodity, currencies, but we're not going to talk about that. So the key part is when you buy an option, you're not buying the stock itself. You are buying a contract that gives you a specific kind of power over that stock, right? It's kind of like futures as a contract. And so it gives you the option to act, but not the requirement. And so that's very different from like buying shares directly where you own a piece of the company. Instead, and it's also kind of different from future contracts where both sides are obligated to complete the trade. And so like with an option, it's if things don't go your way, you can simply just walk away with it and you're never forced to act. And so you're paying for the right to choose later on. Every option comes with two important conditions. There is a strike price, which is the price at which you have the right to buy or sell the asset. And then there's also an expiration date. This tells you how long you have like these rights, like how long the rights last. You could think of it kind of as like reversing a deal in advance. So you're locking in like a potential trade at a specific price, but you don't have to fall through with it unless it makes sense for you. And so that kind of gives you like this flexibility and like what makes options such a powerful tool for investors, traders, institutions, and so on. And also an option is time limited contract that gives you the right, not the obligation, obviously, to buy or sell something under certain conditions. It's like a tool that opens like a new way to participate in the market. And there are ways that can involve less capital, like more leverage or like even a strategic protection. So how options work, we're going to look at like a glance. So like when you buy an option, you're entering into a contract that gives you a specific right. So, but it's not random. You get to choose the exact terms of that contract and you select three main things. The first thing you select is the underlying asset. So this could be like a stock like Apple. You could buy Apple options, an ETF like SPY, or even like an index like the S&P 500, Dow Jones, NASDAQ, etc. Then you choose the strike price. But once again, this is the price at which your contract allows you to buy or sell that asset. The third thing you get is an expiration date. This is how long the contract lasts. And so once it expires, the contract becomes useless. When you decide on these things, you're essentially custom building the kind of bet you're taking in a sense. And you might want to bet that stock will go up in the next week or it will drop over the next 2 months. And so the option lets you do that in a very specific and time limited way. Now, in order for the to open that contract, you have to pay a price up front. This is kind of where the money is made from the seller point of view. And that cost is called the premium. It's like kind of like a one-time payment and it's not refundable. Even if you never use the option, you could think of it like an insurance premium or reservation fee. You're paying for the right to potentially make a trade without being obligated to do so. If there was no premium, it would kind of not make sense because what would essentially happen is you would only buy it if you were to make profit. There was no way for you to lose money. And if there's no way for you to lose money, there's no way for the other person to make money on the other side of the, I guess, of the market in a sense. So there's a premium you have to pay. So what happens is you pay a premium and now you get this right to possibly buy or sell an option at a certain price in a certain date. I'll do a quick example quickly. So Imagine you're looking at a stock and it's right now it's trading at $100. And so what happened is you might buy an option that gives you the right to buy it at $105 within the next 30 days. That is your strike price, and then your expiration is 30 days. And so what happens is you pay a premium, let's say $2 per share for that opportunity. That's where some money gets made from the person selling the option. And so if the stock goes up to $110, your option is now valuable, right? Because it gives you access to buy the stock at a cheaper price. And you can sell the option for a profit. This is where money's made. And so you exercise it and buy the stock at the strike price, which is $105. However, there is also the downside. If the stock never goes up above $105, your option is worthless at expiration. It means you are making no money, and so in that case, you let it expire. And what happens is, since you have an obligation but on the right, you just let it expires and you don't buy the stock at the price because you're not really making money of it. Because let's say you bought the option for $105, but the stock is selling below $105. Well, there's no point for you to buy it with the option because you're losing money like that, right? You're buying the stock at a higher price than it's being traded for. So you let the option expire. And the way the other person makes money is because from the premium. The premium you paid does not get refunded. The seller keeps it, and so on. So there's no further loss, and there's no margin call. And that's kind of what makes it appealing. So kind of to just quickly recap, you choose your asset, the strike, and the time frame. You then pay a premium upfront because the seller needs to make some sort of money. And if the market moves in your favor, the option can be profitable. And if it doesn't, you could walk away and let the contract expire, and your loss is just the premium you paid. And so that's like the core mechanic of an option is you're paying for the opportunity to act and not the obligation. And there's like this flexibility which is like key to understanding everything that follows. And so quickly to end off this lesson, because I don't want to make this long, it's just a quick what is an option. We're going to kind of step back and see how options compare to other popular instruments like stocks and futures. And this will kind of help you see like a clear picture of where options fit in the world of trading and investing. So quickly to start it off, when you buy a stock, you are buying ownership, right? You become a shareholder in that company and you hold on to that stock for as long as you want. There's no expiration. You can profit if the stock goes up. You also receive dividends if the company sends out dividends. And you even get voting rights in some cases, depending on the type of shares you're holding. And so the key idea of a stock is that you own a piece of the company. You have ownership. Next, we have future contracts. Now, these are very similar to options. However, they're a little different. These are legal agreements to buy or sell an asset at a specific price on a specific date. However, unlike options, both parties in a future contracts are obligated to follow through. It means you must. See, in options, you can let it expire. In futures, you can't do that. So what that means is if you agree to buy oil at $80 a barrel next month and the price crashes to $60, well, you're still on the hook. However, futures are powerful and liquid, but they can carry a significant risk, especially if you don't use them correctly. And you usually need more capital or margin to trade them. And that's kind of where options stand apart. And once again, an option gives you the right, but not the obligation to make a trade. That flexibility is a big deal. If you're wrong, you can walk away and all you lose is a little premium you paid. And also, you're never forced into a trade. And this is what makes options uniquely appealing to traders who want leverage and opportunity without the same level of commitment as futures. Also, another important difference is capital efficiency. Buying 100 shares of a stock might cost you thousands of dollars. But buying an option contract that kind of controls those same 100 shares might cost a few hundred or even less. And obviously, of course, with that lower cost comes a trade-off. Options expire, and if the trade doesn't work in your favor, they can expire worthless. So really quickly sum it up. Stocks, ownership. Futures, it's obligation. Options, it's a right to choose. You're not obligated. So it's kind of, if you want to flip around futures and options, futures, you're obligated. Options, you are not obligated. Options in conclusion, kind of options offer flexibility, lower upfront cost, and like the ability to profit in multiple ways in a sense. But they also require timing, which these are kind of like the cons. there's direction, there's strategy. So yeah, that's what made this is kind of like what makes them exciting and complex. They're very similar to futures, but they're also not. And this series is gonna go through options in more detail in the coming lessons. And yeah, I hope you enjoyed this quick little video, and I'll see you guys in the next one.